Hi guys, welcome to the webinar. So just a quick house check. If you can hear me, let me just see show of hands if you can hear me. Thanks a lot guys. Okay, so I'm just going to share the screen, and if you can see the screen, also just do a quick hand raise. That's it, Zoom way. All right guys, so I'm going to put the screen up and then we start immediately. So welcome to the webinar today. It's on target investment plans. That's our topic for today. Before I start, just a quick apology for last week. We did have a slight technical issue, and I tried to send out the video to everyone that requested. So sorry about the last one. I hope this week will be a lot better. We have a topic today, target investment plans, and what it is for TIPS are just investment plans that you have a set target or a set amount, i.e. you're not investing for an absolute return, but you're investing to meet a particular return down the line. That's what I want to talk about. You guys voted for it, and I put together this webinar because you guys want to hear about this. So let's just start going. I have an agenda for today. We're just going to do an overview of financial planning, what financial planning is all about. Then we're going to talk about the time value of money. So we're going to do present value. We're also going to do future value. Just a brief take on asset classes. And then we'll get to the real topic, which is the investment calculators and the analysis, that's the TIPS. Then of course we'll conclude, right? Okay. Again, we are being sponsored today by the podcast The Way I See It, which is my podcast actually, where I talk about money, personal finance, and all that. If you're not subscribing, please do. I would appreciate to have you there so we can all learn together. We're on Apple Podcasts, Google, literally any podcast hosting platform that you can think of. We are there. Would love to have you guys join us and subscribe and also share. So we're onto it. What is financial planning? I just picked the simplest definition I could think of. It's about setting financial goals and then utilizing financial tools to meet those goals. I think that's just a very, very apt description of what financial planning is all about. We want to set financial targets for ourselves. We want to translate those targets to goals. So we want to buy a house, we translate that expression to figures. We want to buy a house worth 10 million in 5 years. We want to save 10% to buy that house worth 5 years or so. And then we try to walk back into and to build out a plan of talking about cash flow, inflation, all those variables. That's really what financial planning is all about. Goal setting with financial tools to meet that objective. I think that's just a summary of what we want to basically talk about. Yeah. And in doing a financial plan, very, very important, you want to have, say, a short-term, a long-term, a medium-term plan, yeah? And most importantly, what's going to be in your short-term plan? It could be like you want to buy a car in a year or two, or you want to increase your savings in a year or two. 15-year plans are going to be things like your retirement. I want to retire in 20 years or in 15 years, and I basically want to have so amount of money saved up by 15 or 20 years. Midterm plans could be, hey, I want to send my daughter to school. I want to maybe buy a piece of land, that sort of stuff. So it's always a good idea when you have plans to break them down by tenure, not really by amount, so that you can give yourself a milestone to achieve to or to strive to. That way you can compartmentalize those targets and try to then reach them. So very, very important that you try to break down your plans into time frames that you can then manage and control, and have someone coach you on that, have someone manage that for you, and you can also measure success. Okay, so I've run through all those little charts, and I'm now on the main one. I would say the main chart about TIPs, target investment plans. So like I said, the main difference with a target investment plan and other kinds of plans is that with a TIP, you are investing with a specific goal in mind. as opposed to investing with an absolute return goal in mind. Look at it this way. If you had, say, 100,000 naira and you wanted to invest, you would say, well, I want to make the highest return possible. So I'm going to buy this particular asset or that particular asset because I want to make a lot of money or I want to grow my principal. That's not what would happen in a TIP, in a target investment plan. In a TIP, you have a specific objective that you want to achieve. You can say, hey, I want to hit 5% in 25 years, or I want to hit 10% in 5 years. So there's a target sum that you're looking out for. I want to retire in 20 years. I have 10 million. I want to have 15 million. So you can see already there's a set amount that you're going for, which then generates a set return that you're going for. So with the TIP, it's also investment, but it's a targeted investment in that you already have an end goal or an end amount or a return in mind that you then want to achieve. And examples could be saving for retirement, planning for to fund the education of your child, or buying an asset. That's just what makes the TIP different. That it's more, you are working towards a set objective rather than just having an absolute return. And because we're working towards a set objective, it changes how we're going to invest or how we're going to look at the investment picture that is before us, as you guys would see as we go along. The whole idea of the targeting investment plans or investing in the future has to go around really time value of money. And if you're not a finance person, you have to really understand this. This is the one thing that I did when I was in school, learning finance, that the same way it was taught to me back then in university is the same way I'm using it today. It's the most, I would say, the most important thing you can learn in finance or in banking or just money management, the concept of the time value of money. And it's very, very easy to understand. It's basically saying that the cash you have today is worth more to you than the cash you would have tomorrow. It's really that simple. So if you have 1,000 naira cash with you right now, it's worth more than, say, 1,000 naira tomorrow or next tomorrow. Why? Because there's risk tomorrow. There might be inflation going up tomorrow. There might be a devaluation going up tomorrow. So you don't know what's going to happen tomorrow. But so because you don't know, you're going to charge yourself a higher rate of return. So thus the rate of the cash you have today gives you, it's better today because you are sure of that cash than tomorrow. So because you are not sure of tomorrow, cash that you're going to receive tomorrow, you want to charge a higher rate of return to release it. So if you have money in your bank account and someone says, hey, I would like to borrow that money from you for 2 years, I want you to lend me also that money for 2 years, you will charge him interest because you are not sure of tomorrow. So the interest you're charging him is to compensate you for the risk that you're taking. That's the whole idea of the time value of money, because money tomorrow is riskier than money today. So you want to then earn a return, because once that money leaves your possession, it has risk, and then that risk must be covered by interest that you're going to receive. So why does the cash value differ in the future? We've said because of inflation. There could be inflation, there could be no inflation, you don't know. No one knew about COVID, but COVID has come and has changed the whole cost of money. Yeah. So you have to plan that in, but you can't know what you're planning for. Hence, you put an interest rate there to compensate you for what you don't know might happen, right? What about taxes? Taxes could go up, taxes could fall. If taxes go up, that reduces the cash value of your, say, your income, because you're going to be paying more to the government. So that's also a risk that you have to factor in and also account for. What about investment returns? Investment returns will increase the value of the cash that you have given away. So if you simply keep cash with you, it doesn't grow. If you bury cash, it doesn't grow. You have to invest money to then make it grow. So if you look at the time value of money, it's basically saying that if you have cash and you don't invest it, you lose. But if you invest that cash, you have to charge interest to compensate you for the risk that you're taking. That's basically what it's saying. And that this idea of the risk, i.e., the inflation risk and the return that you'd get, it changes the value of money that you're going to get in the future, basically. So if you bring that back to the time value of money, so if you bring that back to the tip, to the targeted investment plans, it means that if you are trying to invest for a period longer than 1 year or 2 years, you have to factor in the risk of inflation and the risk of uncertainty and also take into account the profitability or the return that your cash will make if it is invested. Those two things have got to be captured in your plan once you want to invest for longer than 2 years or so. So let's just go ahead. This is just a graphical description of what I've just spoken about. So you have the time value of money, and there are two key concepts there. There's the future value of money. So you're going forward. When you're looking at the future value, you are saying, I have a sum of money today. What's going to be the future value? In this case, what we call is called compounding. You are going forward. You want to know how much, if you have 1,000 naira today and you want to invest it for 10 years, how much will it compound to? Then we also have what's called the present value. So, i.e., you have 1,000,000 naira, or you're going to earn 1,000,000 naira, or a house costs 1,000,000 naira in the future. What does that house cost today? If we bring that cost and we discount that millionaire in the future back to today, what does it cost us today? So we can compare that cost today with other options today and see if that investment actually makes sense. So when we're doing future value, we're going forward. We're trying to ask ourselves the question, hey, I want to save to buy a house in 25 years and I have 1,000,000 naira today. How much will that house be worth in 25 years? So I need to know how much to put money aside today. So we're compounding forward to find out what will be the future value of a current sum of money. So that's what's called compounding. So we have our lump sum and our annuity. But with the present value, we're coming backwards. With present value, we're coming backwards. We're saying the house cost 25 million. What is 25 million in 25 years at today's money? What will it cost us today? We want to know what it costs us today, because if we know what it costs us today, then we can compare and say, okay, how much should we invest today to make that same money? Or are there other better options today we can use our monies to do? So we're looking at both of them, compounding going forward and discounting we're coming back, right? So this is just for you guys to get a pictorial explanation of what this means. There's a maths formula underneath here, but I posted I was going to do maths and lots of people were crying, don't do maths. So I said, okay, we'll just do the figures without maths so you guys can follow. But there's a lot of maths behind this. We'll just try to go forward. So this is it again, the present value and the future value. So present value is really the current value of a future sum. Like I said, the current value of a future sum, because cash today will lose money, will lose value in the future if it's not invested or if inflation attacks it, and inflation will attack it. Yeah. So what you need today to earn an amount in the future, that's basically present value. So where today we want to know what is the present value of a future sum of money. So assume, look at it this way: if you were going to go to, so if you're going to buy a house and the house is going to cost you 50 million, you want to know the value of 50 million in 25 years for today. So you can compare and say, should I actually buy this house or should I rent? Because now you know that house in 25 years today would have cost you, say, 5 million. Okay, should you just buy a house or should you just buy treasury bills? Does it make any sense? You want to compare those options. That's what present value is doing. But with future value, you are going forward. Like you say, we are compounding. You are asking yourself the value of the current asset in the future based on an assumed rate of growth. So you can see that the future value is more or less compounding with the rate of return, while the present value is more or less taking that inflation into account and bringing the money back to today. So these two things, future value and present value, are what you're going to be dealing with when you want to invest for a period longer than 24 months, say 2 years. Once your money leaves your hand, it's no longer the same value that you have. What I mean is, once you invest money, inflation and the rate of return works on that cash, and it is no longer the same sum that you have left out. So you have to account for the change in the value, the cost, and the return of money. It is that definition of that working out what that money is worth. That's what now makes your TIP come to life. If there was no future value or no present value and you simply wanted to invest, it would be simple. You would simply say, how much would a house cost me in 10 years? You know that amount and you simply save for 10 years and in 10 years, you take the check and you go buy the house. It will be simple. There will be no need for any calculation on your banker because you would simply say, a car will cost me ₦1 million in 5 years. Okay, great. So that means I can come back and start to save, say, 450,000 every month till I get to 1 million. It's easy. But you can't do that because once you are saving, the money is losing value because of inflation, but also gaining value because of the return that it's earning. So your target is constantly changing, and you have to then go and pin that target down so that you can plan towards that target. Imagine if you're trying to buy, like Fela said, you're trying to buy a fan in a month, and the price keeps on changing. How can you then plan to buy that fan if you don't know what the fan is going to cost you in, say, 2 or 3 months? That's just what we're trying to do here. If we have a set objective to spend money to achieve a goal, but we cannot determine the final cost, then we cannot plan. We cannot save. We don't know how much to save, and then we're in the problem. So future value and present value allow us to determine the cost of money in future by compounding. Also allow us to determine the cost of that future sum today by discounting. And those two things basically allow us to then take a comparison and then to reach a financial decision. Yeah. So all the stuff I'm saying is for you guys to understand the science behind the calculators. When we get to the calculators, I'm going to give you guys time to log into your own phones or your computers and pull up your own calculators and see what I'm doing. But I want you guys to understand the thinking behind what you're pressing on your calculator. When I did this course in school, there was no internet, there was no calculators. You had to do it the manual way. But right now, all this stuff, future value, present value, they're all on Excel, they're all on calculators, they're all on the website. You simply key in the variables and it does all the work for you. But you have to understand the thinking behind it. That's why I'm taking my time to walk you guys through this. Yeah. Okay, so again, one of the last charts we're going to see. So we're doing the compounding, we're going forward. Yeah, and then we're coming back with the discounting. So when we're going forward, we're looking at the interest rate because that's what we're going to earn. But when we're going back, we're discounting. Yeah, so we're taking the money back from the future date to the past. What we're going forward is present value to the future. So we're compounding or we're discounting. And this will make more sense to you once we get to the calculators. Yeah. Now, this is very important slide. I put this here for a reason because now we've spoken about compounding, we've spoken about future values, we've spoken about what it means. Compounding, we're going forward, and we're going forward with what? We're taking cash. You can't invest cash. Let me explain it to you. You don't invest cash. You convert cash to an asset. Then that asset is invested. So you don't invest cash in a bank vault. You buy a certificate of deposit, or you buy a savings account product, or you buy a bond. The same way you buy, say, equity, you buy shares, you buy commodities, you buy Bitcoin. And when you do that, you've converted your cash to an asset. And it's that asset that then is invested in the market for 3 years, 5 years, 15 years. So it's very, very important that we understand what are the options in the market when we are compounding. So if we're compounding really for 5 or 4 years, these are the options that we're going to have in front of us. You see that we do treasury bills. So on the left-hand side is the less risky assets. As we go right-hand side, we have the more risky assets. But the more risky assets tend to pay more than the risky assets. That's the problem. So if we say we want to invest, then we want to take more risk because it is the volatility that creates the returns when we are compounding forward, right? Okay. So if we are going forward, if we are compounding, which means we are investing forward, right? Because there's going to be inflation touching our funds. There's also going to be returns touching our funds. The inflation takes away, the returns give back to us. So there's always going to be that net off within both of us. So this is basically what we're going to work with. If you have to invest, you can choose to do treasury bills, you can choose to do equities. But in the end, you are investing, remember, to meet an objective, not an absolute return. This is the difference with TIPs. In TIPs, you are investing to meet an objective. So you want to buy a house or you want to educate somebody. You're just not investing to make a return of say 5% or 10%. No, you have a target that you have to hit. So TIPs, which is targeted investment plans, have a target. And because they have that target, we have to then stay on point all across. So I see your question. I will address your question almost at the end, right? Just won't lose my chain of thought. I'll come back to your question. Don't worry about it. Yeah. Okay, so we've talked about the time value of money. We've talked about financial planning, and I put this chart here on asset classes just so that our minds are alive to where bonds are, where shares are, and that understand that when we do bonds, it's less risk. When we do shares, it's more risk, but it may carry higher return. This is to get into our mind that we're going to talk about this as we get to the calculators. The calculators are going to be the real exercise today. All this is just getting you guys all set up so that when we get to the calculators, you already know what we're talking about. Yeah. Okay. Okay. So let me just go to the next slide. And if you guys don't mind, I'll do that. So let's talk about Ada. So now we're talking about a person now, and we have a family, and they have a daughter named Ada. She's 5 years old, and her parents want her to go to Harvard when she's 19. The cost of Harvard today is 49,653, and our parents want to save and invest to meet this goal. So the parents have got a TIP. Their TIP is they want to invest for 14 years. So if you subtract 5 from 14 years to fund $49,653, right? They earn 5 million, they can contribute about $500 a month. Inflation is 3%, risk-free rate is 2%. Okay. So this is basically a person, and this is the demographics of the person more or less that wants to invest. So the job of my job is to take something like this and convert it to a financial statement where we can then work with it, because everyone has this. I am this old, I want to do this, I want to do that. So I want to convert all this stuff that they have told me about that into a financial picture. So I do that by I just have it here. So this is what I have for my financial planning sheet for that. And you guys you can take a picture, you can copy this, whatever you want to do. It's the same principle. Yeah. This is basically what we're going to do. So the metric is going to be, what's the financial goal that we want to achieve here? What's the TIP? What's the target investment plan? We want to have 49,653, and we want to have it in 14 years or 168 months. That's our target. We have an initial deposit of $1,000. We have a return of 2%. Remember that in the last slide, we said the risk-free rate was 2%. So for us, we're saying, okay, if that's the risk-free rate, let's start at that rate. Let's start at 2%. Remember, we're investing in dollars, not Naira. I was very specific on this just because I want us to use the dollar because it's a bit more stable. Naira will change a lot of variables. So let's just use this, but it's the same maths, it's the same principle. It's just the currency that we're using. So the projected return is 2%. And I use the 2% because that was the risk-free rate. That was the rate that if we went back here, if you guys go back here, this is the bonds. You see where bonds are? Bonds are like number 2. So risk-free rate means the return in the economy of the safest investment class, which is normally the government bond. So in Nigeria, the risk-free rate would be, say, the 10-year federal government bond. In the US, it's going to be the 10-year US Treasury bill or bond or whatever, right? So that's the risk-free rate. So in the chart here, the risk-free rate is right there, 2%. So I'm starting off my plan here with 2%. I can go higher, but this is the risk-free. So I'm stopping at the risk-free, right? The family wants to invest $500 a month. They want to do that monthly. They want to also compound monthly. That means that every month, the bank will pay them an interest every month, right? Banks can compound monthly, quarterly, or annually. In this case, the bank is saying they want to compound monthly. These are very, very important questions that you want to ask. If they compound monthly, they get more money. If they compound quarterly or annually, they get less money. So the same 5% compounded monthly gives you more than 5% compounded annually. Just the thing you have to ask your bankers, how many times do you guys compound, right? What of deposits at the beginning? Also very, very important. If you deposit your money at the beginning, you make more money than if you deposit the money at the end. Why? Because at the beginning, the cash has more time to compound than at the end, right? So if you have a third, like a month, if you deposit your funds on the first of the month, then of course you make more money than if you deposit your funds at the end of the month. Like if you pay rent, if you're a landlord, when do you want to collect rent? At the beginning of the month or at the end of the month? You want to collect at the beginning because you can get your money at the beginning and you can invest it. But if you're the tenant, when do you want to pay rent? You want to pay rent at the end because you can use the asset and pay for it at the end. So that's how you guys have to look at it. Yeah. So deposit at the beginning, the family says, yes, want to deposit at the beginning. Inflation, the family says is going to be about 3%. Remember, I'm using US inflation rate here. Everything here is US, yeah? For Nigeria, inflation is going to be, I would use about 16 or something higher just to make it a bit more difficult. What about taxes? I use single family or filing in America, 75,000 per annum, about 25%, yeah? Just to give it a nice round figure. So we can do the exact same thing for Nigeria. The tax rate would be a bit, maybe slightly lower. The inflation rate is going to be slightly higher. And then the 49,000 will convert using 450, do initial deposit. It will give us almost the same return, so that we have more zeros at the end. So this is the planning sheet for that. I've gotten this planning sheet from what the parents told me. So now you guys, if you guys can see if you can download or go to your phone and then see if you can pull up these two calculators. I'm using calculator.net and of course, and also the bank rate calculator. I prefer the bank rate calculator. You guys will see why. So I'll give you guys I'll just give pause for a bit. You guys can have it on your phone. I don't know where you're looking at the Zoom screen from. If you can't do it, don't worry. Follow the presentation at the end. You can go back and do it. But it's open source. I wanted to pull a calculator you guys could use even when I'm not here. So if you guys, I'll give you just a minute or so and pull it up so that the next slides are going to be about the calculator. You can just follow what I'm doing. You can just plug it in. But after a minute, I'm just going to continue. And I had a question. I just take the question since you guys are just on your phones. You said cash will lose value in future if it's not invested. Yes. What about saving for retirement, i.e. pensions? Yes, that's why you have pension fund administrators, because they basically um, invest your money for you. So when they invest your money for you, it's not losing value. Even though inflation will eat that money, at least you get some returns on the money. Because if the money was in your pillow, it wouldn't get any returns and inflation will still eat it. Inflation gets your money anywhere it is. But if you don't invest it, then it's a double loss for you because you have no returns and you have inflation also eating it, right? Okay, great. Is 49 the cost of the school year? Yes, 49,000 is the cost of the tuition only, just for the tuition for that only. And I'm just picking that figure. It can be, don't get too hooked up on the figure. It can really be any figure per se. The whole idea is to say a target investment. So whatever target, it can be 5 million, it can be 1 million, it can be 10 million, doesn't matter, but that target is what you have in mind. You're not saving absolutely, i.e., you're not just saving because you have excess funds, but you are saving to meet a target. That's what changes TIPs a bit, because you have to meet that target every year. You can't just invest, make 5% or 10% and then go away. Okay, guys, I'm going to continue now. I hope you guys have gotten this, but if you don't have the calculators or it's giving you the wrong one, don't worry, just follow. You can always go back and look what I've done. So the next chart, yeah, I'll just log out, guys. It always does this. And I'll just continue with this one. All right, so this is the chart. This one is the bank rate. I don't know if you guys pull this up as well. This is the bank rate calculator. And if you notice, most of what they have here is most of what I had on my planning sheet and more. So we have the investment goal. This is the target. So this was the cost of Harvard, the 49,653, right? Okay. And they had a 14-year. So I had a 14-year right here, yeah, which was her age and 19. So she wants to go to Harvard when she's 19. She's 5 years old. That's how I got one. The parents are going to invest $1,000 immediately. They're going to open their account with $1,000 and they're going to buy bonds. So this return on investment here, remember, it was at a risk-free rate. So we basically bought bonds and the bonds were paying 2%. Let me get my highlighter so you guys can see what I'm pointing to. Sorry about that. Okay. No, yeah, spotlight. Where is the point? Where is spotlight? Spotlight. Mouse. Hold up, guys. Okay, I found it. Yep. I'm not in it. Okay, so so you guys can see. Okay, you can see my mouse. Just want to make sure you guys can see the mouse where it is because I'm going along. Okay, so if you, so 2% here basically is the risk-free rate in the economy. Then this is very, very important. The family said they want to make a $500 contribution and they want to make this contribution every month. So every month they want to put down $500. They're going to start with 1,000, but every month $500. So key information for us there, right there, yeah? Then what else? It's going to be compounded monthly, which means that every month they're going to earn interest on that $500 every month. Then why I like the bank rate calculator is that it gives you in the inflation rate and it gives you the tax rate. So it allows you plug the inflation rate and the tax rate into your calculation. So you can actually see the real after-tax return on that investment. So in this case, I put the inflation rate at 2%, which is the US inflation rate, about 2.53%. I just picked 2%, and I picked the tax rate at 25%. Yeah. So with all this calculation, the computer tells me that my plan of 49,633, I can meet it because I'm producing almost double. I'm producing about 98,000. That's what the system is telling me. So I'm well on my way to meeting my target of 43,000. So that's very, very good. So I'm well on my way on meeting that 43,000. That's what this computer is telling me right now. Let's look at the other calculator just to make sure that we're doing this the exact, that we're correcting in our calculation, yeah? I'm gonna go to the other one, the bank rate guy. This is the bank rate. I'm gonna try to go to this is the other one I told you guys to pull up, the other calculator, and the same thing. So this is the same thing. I'm starting off with $1,000 right here, 14 years right here, 2%, $500 every year. Don't worry, it's every year. I've done every year. And that's almost the same balance, 98. This guy doesn't take into account taxes and inflation. So it's the same 98 that we have here, almost the same. You see the same 98,233, which is 98,331. And this guy is basically 98,003. It's almost the same 98. So we're well above our plan in this case. If the family basically did the $500 a month and all that, we are well above the plan. So like I said, behind these calculators are the future values and the present values working behind this calculator. So they made it very easy for you. You can basically come in here, plug in those figures, and it gives it a return. When you basically come in here and you plug in investment goal and you do 14 years, we are trying to compound. That's what we're doing here. We're trying to compound this amount, this $1,000. We're compounding $1,000 with $500 every month at 2%. That's what basically we're doing. And the answer to that is 98,331. That's exactly what we're doing. So there are other variables. Let me move this out of the way for you guys. There are other variables that we have to consider in this plan. Other variables that we have to consider. The future value, additional contribution, the return, the beginning sum, and the tenure. What the point I'm making is that you can solve for something else in the calculation. Let's say you want to know how much you should contribute. You can simply solve. You can't hear me on the audio. Can you guys hear me? Someone says they can't hear me. Can you guys hear me on the audio? Just give me a thumbs up, yeah? Yeah. Yeah, so the audio is fine. The audio is fine. Thanks, guys. Yeah, just check. Someone said they couldn't hear me. Okay. So the future value, you can solve for future value, you can solve for additional contribution, you can solve for return, you can solve for the beginning sum, which is why I like the other calculator I asked you guys to look at, because that guy allows you to solve for other variables. Sorry about that. I'm gonna go back in, just making sure I can get the person in. So take a look at this one. This is the other one I asked you guys to take a peek at. If you look at the blue line right here, it allows you to solve for additional contributions right here, or the return, or the starting amount, or the investment length, which means that, let's say the family did not know how much they should invest, and they basically knew all the variables. They knew how much they would invest, they knew how much they'll get at the end, but they don't know for how many years they should invest for. It will solve for investment length for them, or to give them the starting amount, or to give them the return rate. So this particular one is pretty good. The bank rate is more robust, i.e. gives you inflation and taxes, which are very, very key. But this guy is a bit more in terms of the spread, or the types of results it can give you. It's a bit much more better to use. Yeah. Okay, so I'm going to move ahead to the next slide. So, so it looks a bit easy now, right? That you can simply plug in your figures and get the result. Well, yes, but let's do some other. Let's look at the next slide here. This is where it now gets tricky. You remember that we were only looking for 49,000, correct? We're only seeking 49,000, but we got 98,000. What does that tell us? That tells we're over investing, because look at the return rate here. They are telling us that we have to do a negative return rate of 8% to make 43. Why? Because we're doing more than 43. We're doing almost 98. So we're over investing. The family is over investing to meet the goal. You see the problem? So they have to cut back a bit, because they are putting the money there and they've already met the target, and they're still investing the money. Because look at the rate of return. It's -8, which means that we're basically, in quote, wasting money. The money is simply there. The target has been met. We shouldn't put money in there again, which is at our 49%, at a $49,000 target, at $500 every month, we're overachieving. So what do? We want to cut back. We want to cut back what we're doing. So we need to either raise or reduce our deposits. And I'm using this as an example, not just for this particular for adapt, but when we do our initial calculations, we are never going to meet the exact target that we're expecting. If we want to buy a house for 25 million, we're never going to have a calculation that's going to tell us exactly, hey guys, you're always going to hit this. Why? Because taxes will change, inflation will change, and returns will change. So when that occurs, what do? We can either raise or reduce our deposits. We can either increase or decrease how long we want to invest, and we can also rebalance our asset mix. So we can raise our deposits, or we can reduce the deposits. If we're doing too low, we raise. If we're doing too much, we reduce. If we're not meeting the target, we can increase the length of our investment. If we're meeting our targets, we can decrease the length of our investment. We can also change what we're buying. In the example with Ada, we are buying risk-free assets. So they are paying us 2%, which is very, very low risk, but it's meeting that target for us. And we can mix this together. We can say we're going to increase our deposit, increase the length, and also increase our asset mix to, say, more volatile or risky investment. So we can mix them all up to achieve a better objective, or to achieve the plan that we have envisaged to hit. This is where the work really is, guys. It's easy to plug in the figures in the calculator, but then when it gives us a wrong figure, or when we do an annual review, we have to go back in again and adjust what we have done, which is what I've done here. So this is the exact same thing I showed you guys. Let me just remind you, look at this. At this rate, we're doing 49,000, we're doing $500 a month. Based on that, we're making a negative return, which means that we were over contributing. We were over contributing to this plan. That's basically what that said. We're over contributing. So how have we tried to get this right? We did that by basically, I'm going to go back to that chat to show you how I fixed this. What I did was I came here and I said, we can either reduce the deposit or we can increase the length of investment or we can do a rebalance. So I came here and I basically reduced this contribution to 50. So see, the additional contribution has gone from 500 to 50. So look at the rate of return. Now, the rate of return has now become positive. But once we touch this, it might also change either the target sum or otherwise, but we can have a negative rate of return. So now it's now positive at 19 because I took the contributions from 500 a month to just 50. So what does this 19 tell us? We have gone from 2% target to 19. Invariably, we have gone from low risk to high risk. So this is very, very bad because now if we have to look for 19%, which investments in the world can give us 19% annually? It's not a lot. So that means that we really cannot just drop this down to 500. We either have to make this way to 50 and probably try to increase the tenure. So we have to now mix and match to get to that target. Guys, are you seeing what the problem is now? Because once we touch something, something else goes bad and we have to go back to fix it because we are not investing to get an absolute return. We are investing to hit a specific target. That's the problem with TIPs. It's a specific target that you're going for. So you can't just change it. So I basically came here and I said, okay, if that's the case, I'm going to come here and I'm going to increase so look at my periodic contributions. Remember, we were doing $500 a month. Now I took that down to half. I said, I'm going to do just $200 a month. So that's $2,400 per year now. So no longer per month, but per year. So I left everything as it was, but I basically I reduced the contribution because here I was doing $50 and it told me I had to do 19%, which was basically not going to work for me. So I said, okay, I'm going to come here. I'm going to reduce my contribution to 200 per month, which is 2,400 per year. And what's the result? The result is down below. If you look down below there, it's basically saying that I'm only going to make $40,000. I cannot hit my $49,000 target. In any investment, if you make a return of 2%, it might be okay. But because it's a target to hit 49, this is not good enough. That's what TIP is saying. TIP says we have to hit 49. So I took my investment cost down from 500 a month because I was overpaying to 200 a month. Now I'm underpaying because I'm only at 40,424. I'm not hitting my target. So then what do? I have to then also amend what I have here. So I then go to the next slide to see what I've done there. I'll take you guys there if you guys don't mind. Again, I remind you guys of this, that we have to either raise our periodic deposits, or we have to increase the length of the investments, or we have to rebalance the asset mix. So here, what I've done again here is I then come here and I increased the percentage. So I left the contribution at 2,400, but I increased the 2% to 4% right there. I increased that from 2% to 4%. So basically I said, okay, I'm leaving my 14 years, my 1,000, my 200 a month, but I'm going to increase my risk from 2% to 4%, which means I might probably go from federal government bonds or government bonds to say corporate bonds. So I'm still in a low risk environment, but I'm getting just a little bit more higher. And because I can go to 4%, I can afford to drop my contributions from $500 a month to $200 a month. But still, I'm just not hitting my target because here, my target is for 49. I am at 47. So I'm still not hitting that target. I'm still short by a few dollars. And remember, it's a target plan. So I have to hit that figure exactly. So then what I eventually end up doing is just simply to increase the tenure of my investments just by a year. So that way I can hit my investment right there. You have it right there. So if I take it to 15 years and I leave everything as it is, I'm now able to hit my goal. So I'm now at 51,000, but I've hit my goal. But most importantly, I'm not at the negative interest that I had because I was over contributing $500. So you can see this, I'm just trying to make it simplified. Oh, increase this, decrease this. But you can see once you change something here, you are really changing something here. Really changing something here. This is what you're affecting. Because if you go from 2% to 4%, you are moving from 2 to 3. That's what's going on. You're moving from 2 to 3. Whenever you take in more risk or you change the return that that portfolio is going to gain, you are changing the asset classes because there is no way you can make 19% and still stay at 1 or 2. There is no government bond paying 19%, or is there cash paying 19%? You might get 19% in stocks, but when you go to stocks, you are increasing the risk of the portfolio that you can go lose the whole money or make much money. That's why TIPs need a manager. That's why you need to know what you're doing, because once you touch something, it's not just the figure you are changing, you are actually changing the asset allocation, which is why I put this up here for us to follow. You are changing the allocation of your assets. Going from 2% government treasury bills means we're going from 2 to 3, which is the corporate bonds. If we didn't hit our target and we had to go further, we might have had to go to 4 or split the portfolio into do 3 and 4 to give the portfolio a bit of growth and a bit of safety. So does that make sense, guys? I hope you guys understand what I'm saying. Once you come in here and we have this figure, see where we started off from. We started off from $500 right here. We did $500 a month. And when we did this $500 a month, we were overperforming at $98,000. That was just a bit too much money. So we came here. If you see, $98,000 was giving us minus 8% return. Basically means we were over contributing to the plan. The plan is just set up, it was too expensive. So we tried to change that by basically saying, okay, let's do $50 from 500. So we dropped for about almost 450. And the plan then told us we had to go to 19%, which is also not sustainable because that means we're taking a high amount of risk. So then what did we do? We changed it now to $200 a month to see if we could increase our contribution, but reduce the risk in the portfolio. That still didn't work because we were short by about $9,000. So what we did was we came here and we increased the return on investment to 4%. So we increased the asset classes that we're doing to more riskier investments. That was okay. It raised up our return, but we're still short by $2,000. And then eventually we had to increase the length of time that we were investing to 15. That allowed us to then meet our target. There are many ways to get to this bridge. You could have simply increased your accumulation time to 15 years or 16 years or 20 years. You will achieve almost the same thing. Or you can just simply increase your rate of return that you're expecting. Or you can decrease the inflation rate, for instance, and then you can also make the same money. So it's the same, it's many ways to get to a goal, but you have to basically know what you're doing, know the asset classes, and know how each variable does affect your investment before you can then basically know, oh, okay, this is what I'm trying to do. Guys, we're almost at the end. Like I said, the real job is rebalancing the portfolio to hit the objective. And we've just shown that it's not, you touch this changes and you have to go back. That's why when you have a TIP, you have got to do your rebalancing almost all the time, especially annually. You cannot leave your plan more than a year without going back to it because inflation will change, government policy will change, return rate will change. Imagine if you had a TIP 2 years ago and you had bought government bonds that were paying 6% risk-free. Now government bonds are paying -0.1, 0.2 returns. So that has changed your entire picture. You have to go back in and rejig all that stuff to get back to where you were basically. So it's almost time for questions. If you guys have any questions now, I will take them. Like I said, this video is going to be up on YouTube once we're done, and I'll post the link on Twitter and also on YouTube. So if you wait for a day, you'll see the link of this video on YouTube. So you can always go back and read it and just take your time and understand it. Yeah. So the 49,000 was the cost of the entire course. Yes, That was the cost of the tool to Harvard. And you can basically put any figure that you want and work with any time frame that you want, and you can get a, yeah. What's the name of the calculator app? I put it up there. Let me see if I can go back to the calculator app. I'm going to see if I can go back to that app so you guys can get it. I don't know if it's, um, let me go back to the calculator, put it up there for you guys. It's Bankrate and the other one, okay, let's get it, calculator.net. These are the calculators that I used. So calculator.net and then Bankrate. Calculator.net is the one that has all those options. Bankrate is the one that has the inflation and the taxes set in there. So yeah, I like the Bankrate more because it gives you a much more, you are able to calculate taxes and inflation, which is very, very important. So Sadiq, yeah, thanks a lot for that question. Yeah. And if we want to do a tip now, do we need to calculate this before going to the bank or a professional, or will they do the calculation for us? I would advise that you do your own calculation. So you have where you are hitting a wall, because what will happen is this: you have a plan. Let's say you want to buy a house in 15 years and you want to contribute 100,000 a month. You will see that either you are contributing too much or too little, or it's not jiving. That's when you go meet the professional and say, hey, this is what I want to do, and this was my plan, but it's not working. What should I do? Then he gives you advice. It's easier for him to give you a directed advice and say, hey, you need to do this or do that. If you don't really do this yourself, you might be over contributing or buying an asset that you don't need to buy. So it's good for you to understand, maybe know where the spark plug is before you go to the mechanic. That's what I'm trying to say. Understand what is going on before you go to just hand over your portfolio to someone. At least know what's going on. Hey, I want to do this, but I'm not getting this return. Can you assist me? What's the risk rating? What's my value at risk? All that kind of questions. So that helps you to basically understand when they then give you a recommendation, if it's right for you and if it's something that you can adopt to hit your plan. So I would say do it yourself. If you don't know what you're doing, yes, trust an advisor, but try to at least understand what's going on, right? Who fixes the return rate? The return rate is, and you have to estimate the return rate based on the risk-free rate in the economy. So in the example with Ada in America, the risk-free rate in America is the 10-year US Treasury bill rate. That rate right now is below, it's almost 0.5 or 0.25, I mean, 0.25 to zero. That's the rate for the federal US Treasury rates, I believe. And I think US Treasury bonds are paying about 0.88 or point something like that, not up to a percentage. So that's your base level. You have to say, okay, this is the risk-free rate. Any rate will be built on this rate. So you then, what you're trying to figure out is to say, this money I have to invest for 15 years. It has to grow. Where will I put it so that it will grow? Because if it doesn't grow, inflation is going to eat it. So you're fighting inflation by investing the money. That's the whole idea. And when you run your numbers, if inflation eats too much of the money, you won't hit your target. So then you have to increase either your contribution or to increase the risk that you're taking so that you can hit that target. That's what you're actually fighting with. You're fighting a battle with inflation and with risk. Because inflation eats 10%, that means you have to invest and grow your money at least 11% to make just 1% return. But to make that 11% means you have to take much more risk. And when you take much more risk, your portfolio is at the risk of basically failing. That's where you are having that push and tug of investing for returns, also being safe in a long-term plan that is very, very difficult for you to basically plan out more than 3 months. Can you plan in Nigeria more or less where the rates can go up? Last year, the rates a year ago, rates were almost 6%. Then they went to nearly 0%. Now they're going back up to 4%. This is in less than 24 months. So imagine if you had a TIP in Naira, you'd have to go back in and adjust and adjust and adjust. And inflation has been going up steadily. So you have to basically have a TIP that at least tries to catch up with inflation. That's the problem that you're going to keep on having. So thanks for that question. I liked it. Yeah. All right, guys. So if there are no other questions, and you guys see your chats, yeah, thanks a lot. I appreciate the comments. Yeah. Are there active corporate municipal bonds in Nigeria? Yeah, there are tons. The Nigeria has a massive bond market, and you can subscribe to it. Talk to your banker or to your stockbroker. Yes. How much do I charge for consulting? Talk to me on Twitter. We'll talk. Yeah, I think that's funny. Okay. Yeah, so I appreciate you guys for tuning in today. I think we're just on time. We have about a few minutes to 12. If you guys have any other questions, sure, on someone says on Bitcoin, yeah, any other questions, I will take them till 12 and then we can call it a day. First Bank trustee offers a children's education trust. Is that an appropriate TIP? Well, it's an account, and for it to be appropriate, you have to ask First Bank trustees how much is the rate of return they are paying to you. Then you have to compare that rate of return to the interest to the inflation rate in Nigeria. Then you then ask yourself, where will the gap be covered? Because the inflation rate is double digits, but I do not think that the trustees rate is going to be double digits. That's going to be the problem for you. A way for you to get about this is to invest in another currency. If you invested in another currency like the US dollar, then you don't have the problem of inflation, but you then have the problem of returns because in dollar terms, the risk-free rate is very, very low. So you'd have lower returns in dollars, but no inflation. In Nigeria, you have a higher return, but higher inflation. So I don't think the point is you are fighting inflation with returns, and inflation can win because inflation goes everywhere, but returns can go everywhere. At a point, you say, man, this is too risky for me. I'm going to pull back, and that's going to be the problem you're going to have. Am I involved with Trove? No, I just use Trove. I use them and they're Nigerian. So I promote them with Robinhood and Planfolio, but they're Nigerian and I use them. That's my relationship with Trove, yeah. Is investing via crypto a good tip? So you're basically asking, should you do a tip by investing in cryptocurrencies? I would say do a mix because it depends on what you want to do. If you want to invest for long term, remember that cryptocurrencies are very, very risky. If you can do 5% just to give yourself some growth, maybe, because you don't know what will happen tomorrow. That's the problem. No matter what anyone says, I think cryptocurrencies are going to go up in price. But we could be wrong. They could crash tomorrow. And you are doing a long-term plan. So I would say not just crypto, shares, currencies, they are very, very risky. So be very careful if you build a portfolio, a long-term portfolio with risky assets. But the problem is this, if you don't put risky assets in your portfolio, then your portfolio cannot grow to beat inflation. And this is the problem you're going to have, this tug and pull of risk and return. That's the point you're going to have because you want to invest, but you can't invest because you are scared of risk. Yeah. How low can low ETFs have a tip? Remember that, guys, TIP is just a targeted investment plan. If you want to invest, you still have to go out and buy assets and invest. The tip is not the investment. The tip is just what you are doing. I hope you make that point. If you are buying VTI, which is an index fund, that's a good tip because you're down buying the US stock market. So you could say, for instance, if I was going to invest to send my daughter to a school in another country, I will try to invest in the currency of the country I'm going to. So I'll take Naira and change to cedis or to Rand or to dollar and try to invest in the currency my daughter's going to go to school in. So that way I have less of a currency risk. I leave this currency and I'm in the other currency. So I'm worried more about the returns in that currency, not really more about the returns or the devaluation or the interest in coin. That's what I would say. So if I was going to invest in America, I would definitely try to invest in dollars, not naira, because to escape the currency risk. Yeah. I have a question concerning ETFs. How can one invest in the United States ETF from Nigeria, especially if one has a long-term goal like 30 years? I think all those apps allow you to invest in America. All those Trove, Bamboo, all those guys, they all allow you to invest in American market from Nigeria. You can download Trove app and you can buy US stocks from Nigeria. The world is now a global village, so you can do that, Mohammed. Yeah, just download Trove or Google it. You'll see lots of options for you to invest. Yeah, thanks for the question. I appreciate it. All right, guys, looks like we're good. Like I said, I will post this for you guys on YouTube, and I'll give the link to you guys on Twitter, so you guys will basically know when to go check for it. So I appreciate you guys for tuning in. I got a nice 1 hour with you guys, and I appreciate that. You guys have a good day. Bye.